It's my pleasure to introduce to you James Gallogly. He's the Chief Executive Officer of LyondellBasell. LyondellBasell is one of the largest chemical producers in the world. $45 billion in annual revenues. They produce in 18 countries. They sell products into over 100 countries. Prior to joining LyondellBasell in 2009, Jim was with ConocoPhillips. He had many domestic and international assignments and served in many cases. He's led their upstream group. He's led their downstream group. He led the chemicals group. He received his Bachelor of Arts from the University of Colorado. He's received his law degree from the University of Oklahoma, completed studies at the Kellogg School of Business, Northwestern University. Please join me in welcoming our first keynote speaker, Jim Gallogly.
Thank you. Well, good morning. In 2008, I had the privilege of working in the upstream business. Oil prices were high, natural gas prices were averaging over $9 an M at that point in time. And E&P companies had adopted a couple strategies to increase production to take advantage of those high gas prices. Some of the major companies were chasing giant gas fields overseas, places like Qatar, places in Africa, Australia, doing LNG projects to bring natural gas into the United States with a price point of around $10 an M, literally spending tens of billions of dollars with you to construct those types of facilities because we thought that that would make economic sense. At that same time that we were chasing those elephant gas fields around the world to produce gas into LNG to bring to the United States, there were a group of independents, people like George Mitchell, who just passed away late last week, that had a different concept in mind. Their idea was that if we could go to the source rock, tight sands, things like shale with low porosity and permeability, and find a way to drill those long horizontal wells and fracture across that well, open up a lot of reservoir, we might just be able to make money at $10 an M. One concept giant and huge capital dollars, another well by well, piece by piece. Today, you know who won. It turned out, the very next year when I was with ConocoPhillips, we began drilling in places that we had drilled many, many, many times before, but at different horizons and with different targets. And we were finding ways to do multi-stage fracs in tight sands and take those wells from about $10 million a copy to 8 to 6 to 5, and find that we could have a 13+% rate of return at gas prices in the $4.50 to $5.50 range. It was going to revolutionize the industry. Gas prices were still high. Things were great in the E&P business. Oil prices were also high. In 2009, I received a call from a rich Russian who owned a company that was in Chapter 11 bankruptcy called LyondellBasell. Basell was a combination of BASF and Shell's plastics business, normally primarily a European company, and they had purchased Lyondell in the United States during the tough times of the chemical business. They put $20 billion of debt against that company, And when the chemical industry collapsed at the end of 2008 with the sinking economy, the company went into Chapter 11 in 2009. This rich Russian called me in 2009 and said, "Jim, you're going to work for me." And I said to him, smiling, "Why would I ever leave the oil and gas business at these kind of prices and come to work for a bankrupt chemical company?" Well, a couple more months of time and watching how these gas wells are starting to develop, I saw something that might just be an opportunity. And so I returned the call and ultimately left ConocoPhillips and came to a bankrupt company to hopefully change the way we did business there. Today I'm going to talk about a few subjects. One, the gas industry, but also NGLs, natural gas liquids, the feedstocks of petrochemicals, and what this gas play has done for petrochemicals. I'm going to talk a little bit about the geology and the economics of these shale plays because that's so fundamental in future projects that you will be developing for industries like ours. Then I'm going to talk about some of those new projects. There's a long list of multi-billion-dollar projects that are not only on the drawing board, but today are in the field. And then I'm also going to spend a few minutes talking about crude oil because it turns out that that is part of the story as well. To begin with, let me just give you a very, very simple summary of how all of these pieces fit together. E&P, both onshore and offshore, exploration production, is the beginning of what turns out to be a number of end uses. Shale plays are generally only onshore. The real estate is too expensive offshore. The production rates and tight sands is too small at this point in time to make this an offshore play. So it's primarily onshore. All of that feeds into gas gathering systems and into processing plants in the field close to the wellhead, where generally we separate Y grade, send it over to fractionation, and put the pieces together that are the building blocks for petrochemicals, things like ethane, propane, butane, natural gasoline. Those are the natural gas liquid feedstocks into chemical processing that then create ethylene, the primary building block of petrochemicals, propylene, and then various other co-products from benzene and a variety of other things. Those go into derivative plants to make things that you see and use every day like polyethylene, polypropylene, different kinds of plastics, glycols, things like your antifreeze, and a variety of other things from propylene oxide that goes into seat cushions to you name it. All of these things are products you use every day. Those derivatives then end up with consumers. Our company concentrates on the olefins crackers and the derivative units. Let's talk for a minute about geology. The United States is blessed with very, very rich geology. The simple fact of the matter is, though, that it's been a place, a province, that's been produced and produced and produced for decade upon decade and decade, and for many years we thought there was nothing new to be found. And the only thing we could go and do was go deeper and deeper and deeper offshore. And of course, technologies developed to do that. We had drilled almost every formation that was out there. We had cored most of those formations, and we knew what was there. Well, the simple fact of the matter is one of the things we knew was there were all of these shale plays. Literally cores of that rock were in all of our universities that had petroleum science around the country. We just didn't know how to make it economic. And so when people like George Mitchell and some of the other people that were really clever in thinking about how do we drill those long horizontal wells in the same formation, and instead of a single vertical well, where we only are able to produce a small zone, if we could produce the long horizon and fracture all along that and break up that tight rock, Wouldn't that be wonderful? If we could go to the source rock and produce it, this could be a revolution. And today you hear a lot about fields like the Marcellus on the East Coast, the Eagle Ford down in South Texas, the Bakken up in the Dakotas, that's more of an oil province. And then of course, a lot of where George Mitchell and some of these other companies like Chesapeake got their big start in the Barnett in North Texas. Field after field where suddenly we have the opportunity to do something very, very special that we knew about many years ago, but just simply didn't have the technology to tap. This is a very important slide, and I'm sure you can't read all of the numbers, but the concept is very simple. Today, with gas prices that aren't $9 to $10, but instead at this moment around $3.60 an M, you have to go for rich plays. You have to have the natural gas liquids or the associated liquids with the dry gas to make money. Because simply put, most of the dry gas fields need a price in the $4.50 to $5.50 range to make sense. So today, the fields that are being developed very, very rapidly are liquid rich, like the Eagle Ford, the Marcellus, and of course, extremely liquid rich oil field, the Bakken. And those have taken off like wildfire, and we've seen a revolution in terms of both production rate and economics. Literally, the oil business is back in a huge way in the United States, and we're on our way to energy independence because of this new technology. On the high end of the spectrum, some of the original plays that look so good, the Cotton Valley, the Powder River, the Piceance Basin in Colorado, simply are not that economic today because they're dry gas, because they have to get that gas to a market, which means transportation and tariffs. So they're on standby at a higher price while these other cheaper plays that are rich are being produced. Well, that's good news to the chemical business, because one of the things that those rich gas plays bring is more ethane and propane. Rig count has fallen dramatically across the period 2007 to 2013. If you look at the left-hand graph, you see that light blue line falling to around 400 rigs from over 1,400 in 2007, when natural gas prices were high. Dramatic, dramatic decline. At the same time, as you see less drilling, you see production increasing. That's all technology. That's more efficiency in both keeping the drill bit in the zone and the multi-stage fracking at a lower cost. And so one of the things that's happened is we've been able to have much higher IP, or initial production rates, from the same wells that we had 5-7 years ago. And even though we're drilling fewer wells with the initial production rate so high, we're adding volume. Truly revolutionary. Very, very strong economics. The problem with these plays, though, is because by definition, they're tight sands. You blow that sand up, you produce a lot of gas in the beginning, the rates decline very rapidly. So you have to drill well after well after well. It's very important that those wells continue to be drilled. This rig count should be a signal that there could be a problem. Now what happens if that rig count drops too far? Production is dropping like that, the economics deteriorate, all of a sudden this magic disappears. It's something for us to watch very carefully. It could come right back, because one of the things that will happen is prices will increase, hopefully to that $4.50 to $5.50 range, and there will be more drilling. More rigs at work, more gas, and then for us in chemicals, more ethane and propane. Well, let's talk about ethane production. In the blue bands, the light blue bands, I'm showing kind of the range of ethane that was produced in the period 2000 and 2011. Something under 1 million barrels a day. Today, that number is above that, and in fact, there's so much ethane, inventories are so high, you can see that on the right-hand chart with that red line showing inventories of ethane today, that you can't use it all fast enough. And so some of it is staying in the natural gas to make it richer, but there's a burner tip spec. When that natural gas shows up at your home, it can only have a certain BTU content. And so you can only put so much of the ethane, that richer gas, in it, and it'll exceed that. So that has to be taken out. And it has to be sold someplace. And it's very difficult to put on a ship because ethane has to be cryogenically or frozen to be shipped. That's expensive, as you know. So it gets used and it gets heavily, heavily discounted for petrochemical producers. Now, many of you know this concept already because in the Middle East, there was stranded ethane a decade ago, and petrochemical companies went in and took all of that and turned it into plastic and shipped it to China and made a lot of money. Today, that same thing is going on in the United States because of cheap ethane. High inventories, not enough use. Unfortunately, a lot of the new production is not where the chemical plants are. So ethane has to be shipped, propane has to be shipped from those basins that I showed you in the first maps down into the Bellevue area to be dispersed to all of these chemical plants. Those pipelines are being built, large quantities of natural gas liquids are moving, and you're seeing a number of announced new plants. So, when does this happy time end for chemicals? Well, we hope never, but it's a very cyclical industry. And one of the things that the chemical industry is famous for doing is overbuilding. We do it to ourselves every time. We start making a lot of money, we have to do something with it, and instead of give it back to our shareholders, we go and build another plant, to the point where we built so much that then the products are in excess, supply-demand curves work against us, and we start to lose money. Well, it looks very good for quite a few years. U.S. ethane production capacity will exceed U.S. ethane demand because it takes 2 or 3 or 4 years to build these plants. So today, it's the best of times in the petrochemical industry. Record profits. Our company just announced last Friday record earnings. It's a wonderful thing. It looks like in 2017, capacity may start to catch up with ethane production. That all depends on what happens on natural gas prices. Because if natural gas prices get in that $4.50 to $5.50 range, it's going to continue for quite a while and be much better than this, I would predict. So, a few simple facts.